It's December 24th, 2025, Christmas Eve. Across most of the Western world, people are wrapping gifts, getting turkeys ready, or traveling to see family. Wall Street is technically open for a half day, but the trading floors in New York feel like ghost towns. Volume is supposed to be dead. The bankers are supposed to be in the Hamptons. Everything is supposed to be calm, quiet, normal. But I need you to stop what you're doing. Put down the wrapping paper and look at the screen, because while the West was asleep, the East just broke the financial system. Ladies and gentlemen, Asian Guy here, and we're not doing hyperbole today. No clickbait. What we're watching are mathematical impossibilities unfolding in real time, moves that shouldn't exist inside a functioning market. We are literally watching the global financial architecture crack in front of our eyes, and most people don't even realize it's happening because they're too busy hunting for last-minute gifts. At 3:30 a.m. Eastern Time, the Shanghai Gold Exchange (SGE for short) and the Shanghai Futures Exchange (SHFE) didn't simply open like a normal trading morning. They detonated. They exploded. What happened in the first 30 minutes of trading wasn't just unusual. It was unprecedented, the kind of price action that makes risk managers bolt awake drenched in cold sweat. For months, we've been tracking the widening gap between East and West. Week after week, video after video, we've told you this moment was coming. We warned that China was systematically draining physical metal from Western vaults, while New York kept playing paper games. We showed you the vault data. We showed you export numbers. We showed you the growing evidence that the two worlds, the Eastern physical market and the Western paper market, were drifting apart like tectonic plates before an earthquake. But what happened 3 hours ago isn't a divergence anymore. This isn't two markets leaning in different directions. This is a full decoupling. This is the moment the global pricing mechanism for silver, an apparatus that has existed for decades, that survived multiple financial crises, that lived through currency collapses and the rise of new powers, finally and catastrophically broke apart. I want you to stare at one number carefully and really understand what it means. $77.8. Specifically, $77 per troy ounce, the closing price of silver in Shanghai today converted into US dollars. Not yuan. Not a theoretical conversion. Actual USD per ounce, $77.89. Now look at another number. The COMEX price in New York right now, as I'm recording this, showing as $723 on the screen, meaning $72.23 in practice. Maybe it's even lower by the time you're hearing this. Maybe it's $7,200 flat. Maybe it dipped to 71 during thin holiday trading. Do the math with me. Take 77.89 and subtract 72.23. What do you get? A 5.66 per ounce spread. Sit with that for a second. 5.66 between the same commodity, the same metal traded on two major exchanges on the same planet at the same time. In the modern precious metals era, the computerized, interconnected, globally arbitrage market we've lived in since the 1980s, we have never seen a sustained spread like this between major exchanges. Never. Not in 2008. Not during the COVID crash. Not during any episode of extreme volatility or severe market stress. Historically, when you compare London, New York, and Shanghai, you're talking about pennies, maybe a few cents, maybe 50 cents, and maybe 50 cents on a normal day, once you account for time zones and delivery logistics. During extreme moments, flash crashes, sudden geopolitical shocks, you might see $1, even $2, but only briefly, a few minutes, maybe 5 or 10 at most before arbitrage forces prices back together. But $5.66, sustained for hours, that isn't a spread anymore. That isn't inefficiency. That's a crime scene. That's proof the system is broken. Because a 5.66 gap means the global arbitrage engine, the invisible mesh of traders, algorithms, banks, and logistics networks that is supposed to keep prices aligned, has snapped clean in half. The foundational assumption behind modern finance, that the same asset will converge to the same price across markets through arbitrage, is dead. Here's what should be happening under normal conditions. If silver is 72 in New York and $7.89 in Shanghai, creating that $5.66 gap, then every bank, every hedge fund, every sophisticated trading firm, and every algorithm on earth should be doing one simple thing. Buy silver in New York at $72.23, arrange immediate transport to Shanghai, sell it there at $77.89, and pocket the difference. That's $5.66 of pure risk-free profit per ounce. Multiply it by 100,000 ounces, and you've made over $500,000. Multiply it by 1,000,000 ounces, and you've made $5.5 million from a single arbitrage cycle. In trading terms, that's free money and effortless trade. No need to predict the future. No need to pass fundamentals. No charts, no timing, no sentiment. You buy low, ship, sell high, repeat. Mechanical, automatic, guaranteed. It should be firing non-stop. So why isn't it? Why is the gap not only surviving but widening by the hour? Why aren't the prices converging? Why are they drifting farther apart? There's only one explanation, and it's exactly what bullion banks, central banks, and financial authorities have dreaded for 50 years. They can't move the metal. They can't execute the arbitrage because when they try to buy silver in New York at $72, they run into something horrifying. There isn't any real silver there to deliver. The number you see on your screen, $723 on COMEX, isn't metal. It's paper. It's a contract. It's a promise. It's an IOU. And the moment someone tries to turn that paper promise into physical bars, you can load onto a plane and fly to Shanghai, the machine seizes. Meanwhile, that $77.89 in Shanghai is the price of reality. The price people are paying for physical silver that exists, that can be held, stored, delivered. The bridge between the paper world and the physical world has collapsed. And on Christmas Eve, while families gather presents get opened and carols echo, the banks are stuck inside the wreckage, watching the structure crumble in real time. Before we go deeper into specific vault data, and I promise you we have breaking news about the Asahi Vault that will shock you, we need to talk about something most people, even seasoned traders, never fully grasp: velocity, acceleration. The speed of this move is telling us something terrifying about what comes next. Humans are not built to understand exponential functions. Our brains evolved on an African savanna where most threats moved in straight lines. If a lion was 300 meters away yesterday and 200 meters away today, you could predict it would be 100 meters away tomorrow. Linear thinking kept us alive. But when markets break, they don't move linearly, they move exponentially. And when you're trapped inside an exponential move, your linear brain screams, "This can't be real. This has to crash. This is a bubble." Not because it's necessarily wrong, but because your brain can't process the rate of change. Look at the timeline of this silver rally and watch how the time intervals compress as the price explodes. That compression is the signature. To move from $20 per ounce to $30, it took 145 days, almost 5 months, nearly half a year of grinding action daily, moves, consolidation, resistance, and support tests. Slow, methodical, exactly the kind of bull market value investors love. Then from 30 to 40, it took another 145 days. Same pacing, still linear, still predictable. Bulls were content, not euphoric. Bears were uneasy, not panicked. The mainstream barely noticed. It stayed under the radar. But then the pattern snapped. From 40 to 50, it took only 39 days. Is not 5 months. 39 days, a time compression of almost 80%. The market wasn't just rising, it was accelerating. From 50 to 60, 12 days. Not 39, 12 less than 2 weeks. Another massive compression. Acceleration accelerating. Then from 60 to 70, 13 days, basically the same speed as the last leg, but at a much higher absolute price. That's the parabolic phase. That's the moment the chart stops looking like a trend and starts looking like a vertical line. And now, right now, as I'm speaking to you, we're sitting at $723 in New York on the screen and $77.89 in Shanghai in reality. We are stepping into the $70 to $80 zone. And based on the velocity we're seeing, based on the overnight order flow coming out of Asia, based on the volume, the momentum, and the near total absence of sellers, this next leg from $70 to $80 might not take 13 days. It might not take 12. It might be done before you even eat your Christmas dinner tomorrow. This is the phase where time stops being the key variable and scarcity becomes the only thing that matters. The market stops asking, what will the price be tomorrow? And starts asking, is there any metal available at any price? Now, I need to get technical for a moment. I know some of you just want rocket emojis and to the moon. Trust me, we're headed there. But if you want to understand why banks are panicking right now, why emergency meetings are happening at HSBC, JP Morgan, and Deutsche Bank on Christmas Eve, you need to understand swap rates, the hidden plumbing of the silver market. This morning, one critical metric flashed dark red. 99% of retail traders never even look at it, and many don't know it exists. But every single risk manager at every major bullion bank is staring at this number right now, sweating through expensive shirts with the air conditioning blasting. The 1-year silver swap rate minus the US interest rate has collapsed to -7.20, -7 Here's why that matters. Under normal conditions, if you want delivery 1 year from now instead of buying today, it should be cheaper to buy future delivery than to buy immediate physical. Because if you take metal today, you must pay storage rent, vault space, pay insurance against theft, pay security, pay transport and logistics. Those carrying costs add up. So the standard healthy state contango typically means future delivery is priced to reflect carrying costs. But right now we're seeing the opposite. The market is inverted. We're in backwardation, and not mild backwardation, but super backwardation extreme. Backwardation 7.18%. In plain English, it means the market is screaming, I will pay you a 7% premium extra money if you give me the metal right now today immediately instead of making me wait a year. Think about that insanity. Someone is effectively saying, I'll pay you $107 for something I might be able to get for $100 next year just for the privilege of having it now. Why would anyone do that? Because the industrial buyers, Samsung, Tesla solar manufacturers, electronics giants, do not believe silver will actually be available in 2026. They're reading the same signals deficit numbers, flat, mine, production inventories draining. They're making a cold, calculated decision. I don't care about the 7% premium. I don't care about storage costs. I need the metal in my warehouse, in my factory, on my production line now. Because if I don't lock it down today, it may not exist tomorrow at any price. That negative 7.18% isn't a quirky statistic. It's a scream from the industrial supply chain. It's panic made visible. Companies that built their entire operating model around just-in-time inventory, assuming silver would always be there, are discovering that assumption was catastrophically wrong. And here's the terrifying part for anyone short silver. It isn't stabilizing. It isn't drifting back towards zero. It's getting worse by the minute. Yesterday, it was negative 6%. Today, it's negative 7.1. The desperation is rising exponentially just like the price. Let me put this into historical context so you understand how extreme this is. In 1980, during the famous Hunt Brothers squeeze when three brothers from Texas tried to corner the silver market and drove prices from under $10 to around $50 in months, we did see backwardation. But that inversion was driven mostly by speculators, a small number of wealthy individuals using leverage to force an artificial squeeze. That was financial manipulation, not industrial necessity. In 2011, when silver hit its prior peak around $40.70, we saw backwardation during portions of that rally too, but that was driven largely by retail FOMO, a speculative fever from people chasing a quick win and remembering the Hunt Brothers story. Emotional buying, not fundamental demand. Today is different, categorically different. The backwardation we're seeing now isn't being led by speculators looking for a payday. It's being driven by industrial necessity, combined with sovereign accumulation companies that must buy silver to build products alongside countries that want silver to support currencies and strategic reserves. These are buyers you can't scare away. You can stop leveraged speculators by changing margin rules. COMEX did that in January 1980, famously tightening the screws with Silver Rule 7, jacking up margin requirements and forcing liquidation when the hunts couldn't meet margin calls. You can shake out retail with volatility, drop the price 20% in a week and watch panic selling. But you cannot shake out Samsung. You cannot shake out a solar panel company that has $1 billion factory that goes dark without silver paste. You cannot shake out an EV manufacturer that promised shareholders 5 million cars next year. These are price inelastic buyers. They will pay $70. They will pay $100. They will pay $200 because without silver, they don't have a business. Without silver factories, stop workers go home, shareholders sue, companies collapse. That's why today is 10 times more dangerous for banks than 1980 ever was. In 1980, banks were fighting speculators who wanted to get rich. Today, banks are short against entities that must buy to survive. 2. Now look at this, through the eyes of the bullion banks themselves, the swap dealers, the market makers, the institutions that exist to provide liquidity. HSBC, JP Morgan, Deutsche Bank. They make money on bid-ask spreads. They profit by being willing to buy when others sell and sell when others buy. They depend on a stable swap market to hedge exposure and manage risk, so they don't get obliterated by sudden moves. But when the swap rate collapses to negative 7%, the plumbing breaks. Liquidity evaporates. Banks that normally lend silver to one another suddenly refuse. The interbank market freezes and the banks get stranded in the middle with massive exposure and no hedging exit. Picture being a banker at one of these institutions. A client comes in and says, "Deliver 1 million ounces of silver to me in London next month." You say yes because that's your business. You don't actually keep 1 million ounces sitting idle in your vault. Banks don't work like that. You assume you can borrow it through the swap market later or buy it when needed. But today, when you try to borrow, the other bank says, "No, I'm not lending. I need my metal. I don't trust you'll be able to return it. I'm keeping what I have." Now you're naked short. You owe delivery you can't meet and you can't borrow to cover. If you try to buy 1 million ounces outright in the open market, you push the price even higher, amplifying losses across your other positions. You're locked in a doom loop with no escape. This is why we're seeing massive vault drains. The banks and players who do have physical are grabbing it and hoarding it for their own survival. They aren't lending. They aren't swapping. They're hiding it. The interbank lending market for silver is freezing solid like water pipes during a winter storm, and when pipes freeze, they burst. People keep asking in the comments, Asian guy, won't they just hit the kill switch? Won't they halt trading like 1980? Won't they change the rules? Listen carefully. They can halt the New York futures market. Yes, they can press a button and stop the COMEX screen from blinking. They can suspend paper contracts. They have that authority and they might use it. But they cannot halt the swap market. They cannot halt the physical market in Shanghai. They cannot halt reality. If they shut down COMEX tomorrow, declare a trading halt force majeure, whatever emergency language they want. What happens? That negative 7% swap rate can go to negative 10. Shanghai can rip to $85, $90. The real market just rats around New York and keeps going in the east. New York is losing relevance in real time. This negative 7.18% is the sound of COMEX dying. It's the sound of pricing power shifting from west to east. It's the death rattle of an empire. So let's take inventory of the breaks in the system we can already prove. Break number 1, arbitrage is broken. That $5.66 gap between New York and Shanghai shows global price discovery failed. Market efficiency, the core assumption that prices converge, has collapsed. Break number 2, swaps are broken. Negative 7.18% backwardation shows the interbank lending network froze. Banks are hoarding metal instead of lending because they no longer trust the system. Break number 3, inventory is broken. And now it gets even darker because screen prices are one thing, watching physical metal vanish from vaults in real time is another. We just got the COMEX silver inventory update for December 23rd, released the morning of December 24th. While most Americans were sleeping off Christmas Eve parties or prepping holiday meals for the second consecutive day, we're seeing massive, unexplained movements out of the registered category. And if you don't live in this data, let me remind you what registered means. Registered inventory is the metal officially available to settle futures contracts. It's the for sale pile. It's what a futures holder can actually take delivery of. It's the physical backbone that gives the paper market legitimacy. Today, technically, yesterday, December 23rd, but reported today, the total registered inventory plunged to 127,281 ounces. That might sound huge until you add context. Earlier this year, registered was above 160 million ounces. We've lost more than 30 million ounces out of registered in 2025, nearly 20% of deliverable supply gone. And what's happening now isn't a slow leak. The last 48 hours look like an accelerating flood. This is a bank run, and I don't say that lightly. Look at the vault by vault breakdown. Look at who is being drained. Asahi Refining. Asahi is a major refiner, a critical node in global silver liquidity and COMEX deliveries. Overnight, meaning from the close on December 22nd to the close on December 23rd, 42,453 ounces were adjusted out of Asahi's vaults. Gone. Removed from the for sale list, the reporting line shows 42,453, and the move is described as over 1.4 million ounces of deliverable silver disappearing from one of the most important vaults in the system. And Asahi wasn't alone. This wasn't a one-off error or a paperwork glitch. JP Morgan vaults, 597,993 ounces withdrawn, nearly 600,000 ounces out of JPM's custody. CNT vaults, 228,780 ounces withdrawn. StoneX vaults, 24,984 ounces withdrawn. Added up, and you're talking about millions upon millions of ounces leaving the COMEX system precisely as prices are hitting all-time highs. And pause on that psychology because it matters. In normal markets, when a commodity hits record highs, sellers show up. People who bought lower decide to take profits. Recyclers ramp up. Miners try to push output. Supply comes to market. That's basic economics. But today, the opposite is happening. The price is at records and the metal is exiting the system at record speed. This is what a bank run looks like in 25. Not people lining up outside marble buildings. It's armored trucks at loading docks, forklifts shifting pallets of bars, owners of metal, the informed players, the smart money, saying, I don't trust your paper promises. I don't trust your futures contract. I don't trust your system. Give me my bars. Give me my physical metal now. Now go back to that $5.66 spread between Shanghai and New York and watch how the pieces lock together into a nightmare for the banks. Many major bullion banks and swap dealers are short in New York. They sold futures promises to deliver at $65,068, $70, back when they believed silver could be contained, when they believed paper would hold forever. With New York at 723 is on the screen, 72.23, those shorts are bleeding. Every $1 up costs millions. Painful, but still within the kind of losses big banks can absorb. But here's the problem. The real price isn't $72. The real price, the price of physical silver you can hold, is $77.89 in Shanghai. If the New York paper market were forced to converge with physical reality, if COMEX contracts had to settle at the true global physical price, those banks wouldn't just be losing money. They'd be insolvent. Bankrupt. Capital wiped out. So what are they doing? They're fighting to hold New York down. They're throwing algorithms at COMEX to keep price pinned near 72, maybe even push it lower if possible. They're spoofing. They're building fake sell walls. They're doing everything they can to sustain the illusion that $72 is the real price of silver. But China is calling their bluff by bidding $77.89. And because China is paying $77.89 as it appears in the shorthand print and offering nearly $6 more than New York, all the physical bars that can still be sourced in the West are being loaded up and shipped east. This creates a COMEX doom loop. Watch the spiral step by step. Step 1. Banks suppress New York to protect shorts, keeping it near $72. Step 2. That suppression while Shanghai trades 77 as widens the arbitrage gap, making the 5.66 profit opportunity even more irresistible to anyone who can move metal. Step 3. That wide gap incentivizes players with physical access to drain COMEX vaults and ship to China to collect the extra $6 per ounce. Step 4, as bars leave registered inventory collapses, like Asahi losing 142,453, described as over 1.4 million in a single day. Step 5, when vaults run dry and deliveries can't be met. COMEX faces a default scenario, paper promises break, and the Western paper system collapses. We are watching the liquidation of the Western silver market in real time. This isn't a temporary dislocation, this is a regime change. For half a century, London and New York dictated the global silver price, the LBMA fix in London, the COMEX futures in New York. Miners sold off those benchmarks. Manufacturers bought off those benchmarks. Investors tracked those benchmarks. Anglo-American finance controlled silver pricing. But today, December 24th, 2025, that authority has been revoked. Not by vote, not by treaty, not by a press conference. It's being ripped away by the raw mechanics of the market. Shanghai is setting the price now. Shanghai is saying silver is worth $77.89. New York is turning into a discount outlet that's running out of inventory. And when New York runs out of stock, the number on the screen won't matter, because a price without physical backing is just fiction, just a number, just a lie. And somewhere in offices that were supposed to be empty on Christmas Eve, the risk managers who got called in are staring at emergency dashboards watching the $5.66 spread. They can't close the -7. 18% swap rate proving metal isn't available to lend, and the Asahi report showing massive ounces walking out the door, realizing they are completely, utterly trapped. Now we have to talk about the why behind all of this again, because if you're a casual investor, -7.18% might sound like technical gibberish. But if you're a bullion banker at HSBC, JP Morgan, Scotia, or Deutsche Bank, that number reads like a death sentence. It's the 1-year silver swap rate minus the US dollar interest rate, and yes, swap rates sound boring, like watching paint dry. But on December 24th, 2025, this rate didn't just wobble. It collapsed off a cliff, telling us the internal plumbing, the hidden pipes and gears that let silver flow from mines to refiners to manufacturers to investors has stripped its gears. The machine is broken. Let me explain it so simply. A 5-year-old could get why banks are terrified. In a normal, healthy commodity market, silver for delivery 1 year from now should be more expensive than silver delivered today. Not less expensive, more expensive. Why would future delivery cost more? Because of storage costs. Vault space isn't free, and you might pay around 50 cents per ounce per year or more, depending on security and insurance. Because of insurance theft risk, vault risk, shipping risk, and because of the opportunity cost of capital money tied up in metal, can't be earning interest in bonds or dividends in stocks. Mechanically, the 2026 delivery price should equal today's spot price plus storage, plus insurance, plus opportunity cost. That's contango the normal healthy curve. But look at what's happening now. The market is doing the opposite. The curve is inverted. The market is effectively saying, if you promise not to take silver today, if you agree to wait until 2026, we'll give you a 7% discount off the current price. That's backwardation. And 7.18% backwardation is not a tiny anomaly, not a blip, not a rounding error. It's desperation made visible. It means the demand for immediate physical possession is so intense that buyers are willing to pay a massive premium to have the metal now because they don't believe it will be available next year at any price. So who is paying that premium? Not retail investors. Buying 10 or 20 ounces for a collection retail doesn't create backwardation. The buyers forcing this are industrial giants who cannot function without silver. It's the solar panel manufacturer running a billion-dollar factory, 24/7 fixed costs. Labor costs, equipment costs, debt, service. We're running out of silver paste, shuts the entire plant down and costs millions per day. They see a 7% premium and don't hesitate because one day of downtime costs far more than 7%. It's the EV battery maker with contracts to deliver 100,000 battery packs. This quarter missed delivery breach. Contracts pay penalties, lose future business, watch the stock implode. They need silver and will pay whatever it takes. It's the electronics firm that needs silver for contacts, connectors, circuit boards, everything from smartphones to servers to spacecraft. This -7. 18% is screaming that the industrial supply chain is breaking, that the smooth flow from mines to refiners to factories has been disrupted, and that factories are so desperate they're raiding COMEX vaults because normal supply channels can't meet demand. We have shifted from a speculative mania buying because price might rise into a supply crisis buying because survival depends on it. And this is why it's more dangerous than past silver rallies. In 1980, we had the Hunt brothers bunker hunt, Herbert Hunt, and Lamar Hunt leveraged speculators trying to corner silver through massive futures buying. They were stopped when COMEX changed the rules in January 1980, with Silver Rule 7 raising margins and forcing liquidation until they couldn't meet margin calls, collapsing the squeeze. Prices fell from around $50 to around $10 in months. In 2011, silver's run to roughly $48.70 was fueled by the public and retail investors reacting to the aftermath of 2008 and quantitative easing FOMO and inflation fear. Retail is emotional and can be shaken out crash price, 20% in a week, run, scary headlines, trigger stop losses, and they dump. That rally died after coordinated sell-offs and margin hikes helped scare them out. But today isn't driven by leveraged speculators or retail panic. Today's buying is industrial necessity combined with sovereign accumulation. These buyers can't be shaken out. You can't margin call Samsung. You can't frighten a solar company that must deliver panels next quarter. You can't convince an EV supply chain to take profits. You can't shake out a company that spent 5 years developing a new solid-state battery design requiring 1 kilogram of silver per vehicle, built new factories for it, and committed billions to automotive partners. These are price inelastic buyers, $70 or $100, $200 if they have to, they pay because the cost of not having silver is worse than any price. And that's the nightmare for shorts. When you short something, you bet you can buy it back cheaper later. But if you're short against buyers who must buy regardless of price, you have no exit. You cover at whatever price they demand or you default. Those are the options. From the bank's perspective, the bullion banks are supposed to stand in the middle. Manufacturers buy from them, miners sell to them, and the bank clips a spread. In normal times, it's steady money. They hedge through swaps and futures because the system is liquid and built on trust. When swap rates crash to -7%, trust evaporates and liquidity disappears. Banks stop lending silver to each other because they don't trust counterparties to return metal. It's like the credit freeze of 2008 when banks stopped lending overnight because nobody knew who would blow up. Now that same freeze is happening in silver. Imagine you're the risk manager again. A client demands 1 million ounces delivered in London next month. Normally you'd say yes, you don't keep that metal sitting around, but you'd borrow it, lease it, or buy it when needed. Today, you ask another bank to lend and they say, no, absolutely not. I'm keeping my metal. I need it for my obligations. I don't trust you can return it. You're naked short, holding a legal obligation you can't fulfill. If you try to buy the million ounces in the open market to cover your buying pushes price higher, exploding losses on all your other shorts and creating a feedback loop. A doom loop. That's why vault drains are happening. Those with physical are yanking it out of the shared pool and hoarding it. Interbank cooperation collapses. The system fractures. And so we return to the kill switch question. Yes, New York can halt futures. COMEX can suspend trading, declare an emergency restrict positions to liquidation only like 1980. Regulators can press buttons, but they cannot halt the swap market. They cannot halt Shanghai's physical trading. They cannot halt industrial demand. They cannot halt reality. If COMEX freezes tomorrow morning, silver doesn't stop existing and factories don't stop needing it. The -7% can become -10, -12. Shanghai doesn't stop at 77.89. It can run to $85, $90. $100. Physical trade continues in the East, while the West's paper market sits frozen. New York gets bypassed. COMEX becomes irrelevant. That negative 7.18% is the sound of COMEX dying, the sound of 50 years of Western price authority ending the sound of global pricing shifting west to east. So let's summarize again, because these breaks define what comes next. Break 1 global arbitrage is broken 5.66 between New York and Shanghai for hours proves price discovery failed and the assumption of convergence is dead. Break 2 swaps are broken. Negative 7.18% backwardation proves interbank lending froze and banks are hoarding metal because trust collapsed. Break 3 inventory is broken and now we have physical evidence of panic. We received the COMEX silver inventory update for December 23rd, published the morning of December 24th. And it's genuinely shocking even for those tracking this for months. For the second consecutive day, we're seeing massive unexplained movements out of registered. Total registered is now 127, 214, 281 ounces silver, officially available to settle futures contracts. Earlier this year, registered was above 160 million. We've lost over 33 million ounces from that peak, over 20% of deliverable supply gone vaporized, removed. And what's happening in the last 48 hours isn't a slow decline, it's a stampede. Look at the vault numbers again. Asahi, refining one of the world's premier refiners and a crucial supply chain player, shows through 453 ounces, withdrawn overnight from their New York vaults described as over 1.4 million ounces walking out the door of one of the most important storage facilities in the entire COMEX system, JP Morgan. The vault, everyone watches given their history in silver shows, 597.93 ounces, leaving their vaults nearly 600,000 ounces gone from JPM's custody, also reported as 597.993. CNT Depository lost 228.780 ounces. StoneX shows 24.984 ounces withdrawn. In total, millions upon millions of ounces are being physically removed from COMEX in a 48-hour window, precisely as silver prints all-time highs. That's backward. That violates normal market behavior. When a commodity hits record prices, supply should come out. Instead, supply is disappearing at the fastest rate we've ever seen. This is what a bank run looks like now. Not lines outside marble buildings, but armored trucks at loading docks, forklifts, moving pallets, owners of metal saying, "Your paper promises are worthless. Give me my bars. Give me my metal. Give it to me now or I'm suing you." We are watching history and most people have no idea because they're wrapping Christmas presents.